Welcome back. Recent economic data in the United States, of course, has raised Wall Street's hopes for a rate cut in September 18th to be specific, by the U.S. Federal Reserve Board. And the markets are hoping for some clarity on that, or at least some signals that might hint in that direction tomorrow when Fed Chair Jerome Powell speaks at the annual Jackson Hole gathering in Wyoming. It's a gathering of central bankers and other finance experts from around the country and indeed around the world. For perspective on all of this and what could inform Jerome Powell's speech, let's bring in Carl Tannenbaum, chief economist at Northern Trust and a former vice president at the Chicago Fed. Carl, thanks a lot for joining us. With expectations so high for a rate cut in mid-September from the Fed, how do you think Jerome Powell deals with that tomorrow when he makes his speech?
Well, good afternoon, Paul. It's certainly always a highly anticipated address, but certainly this year there's an extra emphasis given the recent economic data in our country on inflation, which seems to be moderating, and maybe some signs of a little bit of softening in the labor markets. The most recent numbers that we got on that latter front were not the most encouraging. As you'll know, yesterday, the Labor Department in the United States also revised somewhat downward the trajectory of job creation that we've had so far this year, adding to calls that perhaps the economic risks are ones that the Federal Reserve needs to appreciate a little bit more as they continue to focus on getting inflation to target. All of that, I think, lines up for the first cut here in the United States to occur in September. Now, from there is really what markets and economists are going to be listening for. What kind of clues will Jay Powell give us on the course of monetary policy from September forward? That's what we'll be listening for.
And there seems to be lots of, at least from the market point of view, lots, perhaps as always, of room for disappointment, because the market is now pricing in at least 4 rate cuts, including that one in September, 4 rate cuts in 2024. Is that too much?
From this perspective, it certainly is. And fortunately, Chair Powell has practice at talking the markets down from their expectations. He's had to do that twice already this year. Coming into 2024, the expectation was that we would have 7 interest rate cuts in the United States before the close of the calendar. And fortunately, the chair was able to walk that back and markets complied. And I suspect that he's going to give a similar kind of message of moderation that should try and get those expectations back into alignment with what is most likely to occur.
You said recently that that risks on the two sides of the Fed's mandate are roughly balanced. That's an interesting view. Tell us more about that.
So for most of the last couple of years, inflation was job one. Economic activity in the United States was not in question. We've outperformed expectations persistently over the last 2 years, and in some cases by a lot. But now the signs that we're getting from our labor market could be early warnings of a little bit of difficulty ahead in sustaining the expansion. And so as the Fed thinks about the impact of higher rates, which we do see in the markets for housing and autos most prominently, they may need to think about cutting back a little bit on their restraint so that they don't lose the opportunity at a soft landing by being too strict on economic activity.
You view the weakening of the labor market as a normalization. Your view is that unemployment was unsustainably low for a period of time.
Most economists think that the sustainable unemployment rate in the United States is somewhere around 4.5%, and we are still below that. Now, that's wonderful for job opportunities and consumer incomes, so I don't want to sound like dismissing the concerns that, we have more people out of work today than we did a year ago. Nonetheless, in the long run, if we're to sustain good employment market conditions, I think we have to keep in mind, a good balance between supply and demand, which we are achieving. Certainly also, we've had persistent job creation and not job loss. The size of those gains has been moderating, but in many other contexts, Paul, this would be viewed as a very, very good labor market.
Or I should say, the annual pace of inflation in this country was most recently reported at 2.5%, and our central bank has said it expects 2.0 sometime by mid-2025. Can the Fed, and the Bank of Canada has reduced its rate twice, can the Fed reduce rates and still expect inflation to continue declining to the much cherished 2.0% target?
I think the answer, Paul, is yes. The chair has already said that if a central bank waits until inflation is at the target to begin cutting rates, they've waited too long. And so that's the spirit. Let's not forget that even if the Federal Reserve begins lowering rates, they're still on the restrictive side of neutral. And so we need to have a smooth path to that neutral, and that means starting with small steps now. On the inflation front, by the way, Paul, I'd like to ask you a favor, and that is if you could solve the Canadian rail strike so that both of our countries don't experience undue inflation, I'd be very appreciative.
Yeah, I think there's a lot of